What if raising private money was not about hype? What if it was just a system? And what if that system could scale to hundreds of millions of dollars without you being a Wall Street insider? Well, today's guest has done exactly that. Welcome back to Raising Private Money. I'm your host, Jay Conner, and today I'm sitting down with Lane Kawaoka, a guy who didn't just raise private money, he's raised over $200 million of it. And I've been so blessed to be in a mastermind for a number of years with Lane. Now, Lane owns and operates more than 10,000 units, runs the Wealth Elevator, and comes from a background most real estate investors don't. He's a licensed professional engineer who's managed over $250 million in large-scale construction projects. But here's the key part. Lane didn't start out as a real estate guru. He walked away from a high-paying corporate career and built a repeatable machine for attracting accredited investors, one built on trust, data, and alignment. He co-invests with his own capital, he backs deals with debt, and he raises money for multifamily, RV parks, mobile home parks, and hotels at scale. He's also the host of a top-ranked investing podcast and the author of The Wealth Elevator. So, if you want to understand how sophisticated investors think, how real private money actually gets raised, and how to build long-term wealth without guessing, you're in the right place here on this episode. You're going to get to meet my dear friend Lane right after this.
If you're a real estate investor and are wondering how to raise and leverage private money to make more profit on every deal, then you're in the right place. On Raising Private Money, we'll speak with new and seasoned investors to dissect their deals and extract the best tips and strategies to help you get the money, because the money comes first. Now here's your host, Jay Conner.
Lane, welcome to the show, my friend.
Hey, good to see you again, Jay. It's been a while.
It has been a while. So good to see you here on the show. Now, let's go ahead and dive right into it. Now, Lane, you've raised over $200 million, $230 million in private money. Let's go all the way back to the beginning. Did you have any beliefs? And if you did, what were some of your first beliefs that you had to unlearn before anyone started investing with you and, loaning you their capital or investing in your deals?
Yeah, I mean, initially I kind of just fell into this world. I mean, a lot of my kind of friends and family were the first initial, as they sometimes say, chumps, I guess, right? When you're kind of getting a track record and getting going. That was back in 2016. But prior to that, I've been investing in little single family homes since 2009, 2010. So, I mean, it's not like they haven't heard of me doing this stuff for quite a while, but yeah, I was always reluctant because, when you take on other people's capital, it's a lot of at risk, right? Emotions get involved, relations get involved. I mean, I think I try to, build relationships with every single investor, try to meet them face to face and, try and be that, that person they talk finances with and build that relationship. So it gets heavy, right? Stakes are high. And initially, I was very reluctant to doing it.
How did you overcome that?
Well, so initially when I jumped into this world in 2016, I want to just be a passive investor. I was, running around a lot of groups, before, I kind of ran into you. I think that was years before I ran into you. And, you get around other operators that are kind of just starting out, right? I call them the people under $1 billion of assets under ownership or acquisitions. And I was just looking to invest my money because at the time I was trying to sell my 11 single family homes and redeploy it into syndications of private placements, specifically in multifamily and specifically with projects that had a value add play. Because prior to that, I was just doing the buy, hope, and pray strategy and my equity was building up, right? And as good investors understand the concept of return on equity, at some point you kind of got to trade in your pieces and re-leverage. And, but also enact the power of value add, right? By increasing rents or decreasing expenses to bump the NOI. And that's the magic of commercial real estate, right? So I wanted to tap into that. I was completely sold on it, but then the question was like, well, all right, where the heck do I do that, right? Because if you go to the secondary markets, which stock markets, big REITs, right, you're getting diluted so much by all these hidden fees, and you're not really directly into the investment. And then, there's a lot of crowdfunding websites out there that supposedly get you into a deal more directly. But in reality, a lot of those folks, I mean, you can't really tell which one is a good deal and which one paid the person to be a sponsor or just paid to be on the platform. So, I mean, I didn't know this at the time. So I was just kind of a chump, just meeting people, getting a good feeling. And, my first 15 deals that I invested in as an investor, I mean, I would probably look back, and it took me pretty quickly to realize maybe 2 or 3 years later that, oh, shoot, maybe I shouldn't have invested with that individual, right? And then I realized, look, a lot of these people just didn't have the track record or the pedigree. And I was like, you know what? It kind of had a soul searching moment there. And I was like, if someone is going to do it, it's somebody with like a, professional background. I was a construction manager, and, and I kind of took it upon myself to like, if I'm going to invest my cash, I'm going to be in the general partnership myself and kind of see what's happening and help out. Right. I mean, some people want to get on the other side of the curtain, but they don't want to do anything. Right. I wanted to be a more of an activist investor. So that was kind of where it all kind of started. Right. Like I kind of got screwed initially a little bit, and I got upset, and I wanted to do something about it and become, my own advocate.
Now, Lane, most real estate investors, at least from my observation, they struggle to get past their first few private lenders. So what did your early capital raising conversations sound like before you ended up with such a big, track record?
Yeah, I know what you're talking about, right? Like, I mean, anybody can raise $1 million or $2 million from your friends and family round, right? Or people that you have physical connection to. But once you burn through that, you're kind of SOL unless you have a big flywheel of folks. I kind of, after I did a little bit of that friends and family realm, I kind of fell back on my organic traffic that was coming in. I've been podcasting since 2016 and built up a bit of a following, right? But the nuance there, which again, I don't know if it's useful advice, but it's just my story, is that I was talking about buying little rental properties. In fact, I had a coaching program where I would teach people how to buy little rental properties remotely, and did that from 2016 to about 2018, 19, right? But if you remember my story, like I was investing in multifamily syndications starting in 2016 myself, but really didn't turn on that switch that you mentioned to kind of open up for private capital through that channel until like I had gotten a little bit more of a track record 2018 and beyond. So it wasn't like people came on the list and they initially got bombarded by these deals. It was more so I had built up a community and a track record, at least 2 or 3 years of something else. And then, I see some people will say, well, you switched and bait them there later. But I guess I call it more of an organic transfer, as I never felt comfortable talking about something I didn't do, right? Like in my new book, The Wealth Elevator, I taught everything's an experience share. So not something I'm just making up, something I've gone through, and I can look back years back and have the, let me revise that a little bit. That's already been taken into account. And that's what I wanted to do. I wanted to get into these multifamily syndication deals starting in 2016, get a little bit of the first year jitters out. And like I said, there's always some. I went through it. And then I started to bring in and talk about it more on, like to my audience after 2018 and beyond.
Now, as I said in the introduction, you come from an engineering background. Some of my friends would call the engineers a thinker brain. So you got the engineering background. How would you say, how does thinking in systems and processes change the way you raise and deploy private money versus maybe some other operators?
Yeah, I think what sets us apart from other people is like we actually tell people reasons why not to invest first. I mean, it all kind of falls on like, I mean, our process. When we look at a deal, we pull up the raw financials, the rent rolls, the P&Ls, and we throw it into our analyzer first. The one that's not, with the cookbooks and the fictitious and numbers and the overzealous reversion cap rates and overzealous rent increases, right? Like, I kind of want to, in a way, like do the test, but not look at the answers first and see what I get. So I run the P&Ls, rent rolls through our own analyzer and see where I get. Like for example, a lot of folks they'll use like these days. I mean, I see. I don't want to say exactly what market is because I don't want to get in trouble. But it's a very common Sunbelt market, and I think they're using a reversion cap rate of 5.25. To me, that's super aggressive, and we would underwrite that with nothing less than 5.75. If people don't understand what that is, I have a full e-course on my website we give for free about how to, this is the talk of reversion cap rate. If people go to ChatGPT and have, just put that in and say, what is a reversion cap rate? I think you can kind of self-teach yourself. But a lot of these things, if you're unaware of, you just don't know. Like another example is rent increases per year, these escalators, right? Like if I'm building a bridge, like this is the last project I worked on when I was an engineer, because I quit in 2018, was building a bridge in Washington. And, as you guys know, projects always take, it always get delayed years. So you add an escalator on there to account for inflation, right? Typically in a construction project, you just throw the standard 3% in there for inflation. Who knows if that's right these days, right? But in these multifamily deals, what you try to use an underwriting escalator every year of like 2 to 3% that you think that the income is going to be going up. Some of these markets, and hopefully I don't upset people in Oklahoma City, but Oklahoma City is not a very good market. So I wouldn't really use anything higher than 2% a year on my escalators, right? Now maybe a Phoenix, Arizona, which is a very cyclical market. So that's another topic for another day. But you might be okay using something 2% or higher there. But these are the things you spot check as an investor that we do, and we take a systematic approach of like looking at the numbers first, seeing if we get the same projections or it meets our projected returns criteria before we even kind of move into the second stage. So it's a very like, I don't know, maybe it's like an antisocial thing or engineer thing, but I want to look at the numbers first before I even waste time talking to the operator or looking into the deal from that point.
Well, what you just said about looking at the numbers first, it reminds me of a good friend of mine, Darren Bentley. He's an amazing podcaster. One of his favorite phrases, I hear him say it all the time: data, not drama. Data, not drama. Let's look at what the real numbers are. I started raising private money back in 2009. Started investing here in Eastern North Carolina in single family houses in 2003. My first 6 years, I just relied on local banks, mortgage companies. I don't even know what hard money was. Of course, hard money is very, very different than private money. But you know what's interesting, Lane? When I started raising private money in 2009, I've never asked anybody for money. I've never pitched a deal. The reason for that is we separate conversations between offering the opportunity and what we pay and how we protect our private lenders, and then actually having a deal, a single family house, to have them loan money on. With that being said, a lot of particularly, well, I was going to say new real estate investors, seasoned real estate investors, think that raising money is about pitching. With that being said, you have said that attracting or raising private money is more about alignment. With that being your philosophy, what would you say, what does alignment actually look like in practice, the way you do it?
Yeah, I mean, it's something I've learned over the years. I mean, when I first started to do this in 2018, I mean, there was very much, bespoke one-on-one with all the investors. I used to say, yeah, let's get on, let's just talk shop, once or twice a year. Now, I think very quickly I got up to 300 investors, and now I think I'm about 3x that, right? People who've actually invested, multiple 5 figures with us. And obviously we grew the team, right? I still like to have that personal relationship, right? So when people meet our company, they talk to me, number one, and what I'm trying to do, and I try to, I get a sense of when certain people fit in a way. And it's good when people have invested in private placements and syndications in the past, but I tell them like, hey, this is actually worse than a marriage. And, because you can't just get divorced 6 months or 12 months after the wedding, right? You and I are stuck with each other, good for better or worse. You sign these PPM documents, and that's really the pitch is, right? Like, nothing prior to that is a sell or pitch. Everything's in those disclosures and those documents. So, and if this isn't for you, then, please let us know now, right? Like, let's try and going back to, like you said, the alignment. People, and this has been further confirmed that, commercial real estate got hammered, right? Is down 20 to 30% off the peaks of 2022, right? And we've kind of lived through that, and, still fighting and still surviving. Luckily, we had a lot of projects prior to that were very successful. But, you go through the process, and what I've kind of realized is going back to my earlier piece about data, right? Like, look, like, even if you're investing, Jay, I'd be like, look, hey, here's how the numbers work. We're going to do the sensitivity analysis. I don't know if occupancy will go down to 50%, right? I mean, that's why you're investing in real estate, because in theory, if you can look at the supply and demand, right, like you can make your own conclusions for that. But, it's a lot less riskier than investing in operational business, right? But, you kind of look at the numbers and you're like, well, look at certain risk factors, right? If this goes up and down this much, this is where the projections will lie. Like, for example, we've done oil and gas in the past, right? Like, I think that's just using that as an example where it's actually a lot easier in a way. There's a lot of things in the black box in the underwriting, but just for conversation speak here, one of the big inputs that drives the numbers that, again, I think this is just super easy conversational wise to conceptually understand, is you have on the spreadsheet usually a big cell that like drives the numbers, like the reversion cap rate for multifamily, for example. For oil and gas, it's the price of the oil, right? Or there was a horrible deal that I told nobody even touch with a 10-foot pole, was like this crypto mining machine, like several years back ago. And like, I asked, like, well, what is that one cell in the spreadsheet that drives this model, right? For that one, it was like, what the heck the price of Bitcoin was, right? Which is super speculative. And, it doesn't really matter how you operate it. It's just how well you underwrite that asset with the going in price. And just like the oil, right? If you're able to underwrite it at a certain number that is conservative, then you should be all right. And I'll highlight that you should be, right? But anything can happen. There's risk in everything. At the same time, if you don't risk it, no biscuit too at the same time. But I think it's smart to go into a deal where you know that the underlying assumptions are conservative, and you go into battle knowing that you've kind of protected yourself in that manner. Now, you'll never have 100%, nothing's 100% safe. If you believe that, do not invest in any private investments, period, right? But I think it's good to go on eyes wide open where that is, and how conservative your assumptions, how well can things bend, how durable are the numbers before you go in.
That is very, very wise advice. And what kind of appetite does a investor have in investing in these types of investments? I mean,
Yeah.
if you're going to be wanting to like get an update every week, this is probably not for you.
Yeah. I'll give you a good example. Like, if you and I were talking about a deal, right? Like, you may want to diversify. I know you've done multifamily, but, say you and I were talking about the reversion cap rate, right? I'm like, hey, Jay, this isn't the only, thing to look at, but I would probably say it's number one of the top 3 things that passive investors should check under the hood and spot check. You don't need to be an underwriting specialist, but these are things to spot check. And, like I said, say you have a Class B in Dallas, right? I think, I mean, don't quote me on this because things change all the time, but let's just say the prevailing cap rate for Class B in Dallas is right around 5.5 these days. I don't know exactly where it is, but just for conversation's sake. Now, what I'd like to see as an investor going in is maybe a reversion cap rate of 6%, right? Something to increase the cap rate, which is a little counterintuitive to new investors. But when you increase that reversion cap rate, that is the assumption that you're selling it into a worse market, a softer market. So you're smart investors. So you're like, all right, what do you use for what do you assume that the market's going to be, which is encapsulated in that reversion cap rate at the end. And they're like, oh yeah, seems reasonable, right? Today, these things are selling at 5.5. You guys are assuming that we're selling it into a 6 market. I think you and I were both gambling men and maybe a terminal optimists too, right? That we may see that stay at a 5.5 or get better, right? Which is where the returns skyrocket, which was kind of what was happening prior to 2021. But I think, if you and I are friends, right? Like, and this is like any other investors, like, I want to just be able to tell you, like, in the face, like, look, things could happen, but these are the assumptions. So if the cap rate jumps up to, like, what we saw happen was the cap rates jumped up 1.5%, right? That's where you get a decay of 20 to 30% off peaks. So in that case, to use that Dallas Class B example, if you started out at 5.5, the market went to like a damn near 7, right? Like, and at that point, like, I guess what I'm trying to do is, at least so I can sleep at night, is like, at least, look, Jay may still be upset with me, but at least he knows what happened, right? Like, we all, we're all partners at the end of the day. We all jumped into a deal where we assumed that the market could get worse from a 5.5 to 6 market, but the damn thing went 3 times as worse than that. An analogy I like to use is like, look, we had a storm coming in Florida, which, by the way, increased insurance a lot these last several years, which is now starting to come back down a little bit. So that's good news. Like, we built a sandbag wall for 10 feet up in the air. And most people who've done this before say, hey, it's pretty reasonable, pretty freaking reasonable. But what we saw was a 30-foot wave. And which is why right now is a great time to get involved in this stuff today while you're buying a lot lower. But, like, I think where I have a problem where investors are, they come back and, a lot of it's emotional, right? Like, well, what do you mean you didn't build a 30-foot wall? Right? Well, first of all, everybody had the same assumptions, or should have understood it in the beginning, that, we build a 10-foot wall because that is reasonable. If you don't like it, please do not invest. Right? So at least, both you and I, as friends, when going into the deal, right, we know what broke. Not, Lane, you screwed me. I thought you and I were friends. Like, well, I didn't bring that wave. I didn't want to know who put that wave over the top of that sandbag wall.
Right. And you did your best in that alignment conversation to point out the risk to them, right? It's like with our private lenders, and we focus on single family houses, but with our private lenders, well, for one thing, in my world, none of them are sophisticated, to tell you the truth. They're just looking, it's lazy money, and they're looking for a higher rate of return, safely and securely. So as part of alignment, well, we give them as much protection as we can. We give them all the same protection that a mortgage company or bank would get. We're not borrowing unsecured debt. We give them a deed of trust or mortgage, and we name them on the insurance policy as the mortgagee in case there's ever a claim on that. So I'm really in tune with you, Lane, as I already knew I was, as far as your alignment. Now, this is your favorite topic to talk about that we're moving into right now as we go into the last segment. And that is, you love talking about the different levels of wealth after building, where you talk about different levels of wealth building after they got $1 million net worth. So tell me in the audience what you think about that. Tell us about the levels of wealth building after $1 million net worth, and why the strategies that get people to $1 million often break down and don't work after that point.
All right. Yeah, this is essentially what I got in my book, The Wealth Elevator. So what I have in there is like essentially a table of all these levels that I've been through over the last decade, almost 2 decades now, when I bought my first rental property in 2009. Now, when I first started out in 2007, I graduated college, decent income, but essentially zero net worth. At that point, I was what you call is on the first floor of the wealth elevator, right? Like I wasn't in credit card debt and I had a good salary, but I needed to just buy little rental properties and plug away until becoming an accredited investor, which we call the second floor of the wealth elevator. Now, going from the second floor to the third floor is a little bit of a nuance of once you've hit your end game. I think a lot of your investors, Jay, kind of fit this category of folks that have that lazy money. They don't really need it, but they want to keep it working in a safe position, like your private money lending, right, on your flips. Where I think there's a lot of investors that haven't hit that stage, and it's different for everybody. I would probably loosely call it anywhere from like $3 million to $4 million net worth. The reason being is at that point, you could just put in life insurance or T-bills and T-bill and chill at that point. But, what are the guys doing between $1 million to $2.5 million, right? Like that's what the second floor of the wealth elevator is. And that's essentially what the book, I think most of the content is for those folks in that second floor. And for those people, you've got to take on a little bit more risk to get a little bit more reward because you're still in the growth years and you still have a lot more time on your side, right? I'm not giving anybody financial advice because I'm not a certified financial planner. So I can't talk about asset allocation mix and things like that. But, maybe just repeating what I've heard from that world, and it's somewhat true, reluctantly, I would admit, is that when you're younger, and you should be taking on more risks, right? And as the years go by, they titrate you down to more of those your bond count goes up as opposed to your equities. To me, it's very similar, right? Like in the private real estate or private equity world, when you're growing and you're more risk tolerant, you have more time on your side, you get into more common equity sides with higher returns, higher risk. But at some point, you kind of take the foot off the pedal and go into cruise control. And this is kind of where, the book talks a lot about, titrating or transitioning to that phase. And, it's not like you're investing 100% in multifamily value add syndications and then you go to private money lending right away. No, it's not like that, right? You kind of slowly transition into that world, and you've got other investments, right? Like these days we do private equity investing in businesses. We do oil and gas, we do energy, right? Other asset classes other than real estate. Now, I'm not going to get into what the best mix is because I don't think there is a best mix, right? That's why we do events where people get to interact with other accredited investors on their level, and they can kind of mastermind on these types of deals. I mean, just the way that you and I met, right? Investing as operators. What are the best practices? Because none of this is on Main Street, right? Those people are just investing in the standard protocol, the 60-40. And I think the people who are listening to a podcast like this are definitely on the other side of the tracks. But we all get to a point where net worths grow, hopefully to 3, 4, 5 million, 10 million plus. And I do talk a little bit of what happens after the third floor of the wealth elevator when you're getting beyond there. Typically, if you're not a business owner, it's going to be pretty hard to get to, 15 million, 20 million plus in your generation. But the idea is to line yourself up to become that family office in the future, right? You may not be $100 million net worth, but there's certain things that you can emulate that I've seen that I implement myself that we also talk about at the end of the book there too, right? Like hiring your own legal team, your own CPA in a fractional standpoint, but then sort of outsourcing the deal finding for you. Because right now, I think everybody listening is looking for your own deals, right? At some point, you start to use professionals who are kind of your guns for hire out there. And a lot of this is what I've kind of learned and trying to emulate what family offices do. I've been lucky enough to interact with a lot of these people, and maybe it's from my podcast, or a lot of times we'll buy properties from these types of individuals. I know you and I, Jay, we've been in these different masterminds together, and there's a lot of wealthy people there, right? I mean, it's all your network is your net worth. And essentially what I do is I try and pool these best practices and I put it into the book.
Well, Lane, you've got an amazing book, lots of wisdom, people that are interested in growing their wealth. I want them to get a copy of it. So what's the best way for them to connect with you and get your book, The Wealth Elevator?
Yeah, they can go on Amazon, The Wealth Elevator, and special offer for Jay's folks. If you guys buy it, leave a nice review. We'll hook you up with the MP3s and the digital version. Can't stop you from sharing it from your friends, of course, right? I know you're real estate investors. You guys are always looking for a bargain, right? Deal hunters out there. But yeah, just if you do that, just shoot us a email, team@thewealthelevator.com, and maybe put Jay in the subject line, and then we'll hook you guys up.
That's awesome. So there is Lane's website, www.thewealthelevator.com, thewealthelevator.com. And of course, that is his book. Lane, thank you so much for coming on and sharing your wisdom on this episode.
Yeah, thanks for having me, Jay. We'll be seeing you around in person.
I hope so. All right. Well, that's a wrap for today's episode. If you're listening to this and you realize that raising private money is not about charisma, it's not about hype, it's about systems, alignment, and trust, then you got exactly what you needed from this conversation with Lane. Lane did not talk theory. He laid out how real wealth is built after $1 million, and you can really learn all about that in his book. How sophisticated investors think, and why the people who win long-term are the ones who play offense with structure and, according to Lane's advice, not emotion. So if you want to go deeper into Lane's world, check out his book, The Wealth Elevator, his website, thewealthelevator.com. Listen to his podcast and grab this amazing book, because the frameworks that Lane shared today are the ones he's used to raise over $200 million in private capital. And if you want to learn how to raise private money for your own deals without begging, chasing, or sounding salesy, make sure you subscribed to this podcast and share this podcast with one other person that you know to make a difference. Like, subscribe, share. If you're on YouTube, ring that bell. Well, we break down exactly what works from real operators who are doing real deals with real money. I'm Jay Conner, your host, and this is Private Money, Raising Private Money Podcast. I'll see you right here on the next episode.
Are you feeling inspired by the knowledge you gained in this episode? Then head over to jconner.com/moneyguide. That's jconner.com/moneyguide and download your free guide that shares 7 reasons why private money will skyrocket your real estate investing business right now. Again, that's jconner.com/moneyguide to get your free guide. We'll see you next time on Raising Private Money with Jay Conner.